Hi, this is Linda Hitt. We're going to look at the accounting cycle using the horizontal worksheet, which is a quick way to do an input. So we're not going to, later you will learn about journals, general ledgers, and trial balance. But for now, we're going to use the worksheet for the input, and then the outputs will be the income statement, balance sheet, and cash flow. So the types of events that we'll be recording. First part will be the daily transactions or daily entries. Usually for these entries we'll find a document such as a bill, invoice, cash in, cash out. Something usually triggers these entries. Something has to happen first, so they're historical. We're not recording things that are planned or pro forma or budgeted. And they have to impact the equation, which is of course assets equal to liabilities plus stockholders' equity. And as we go through the entries, we'll make sure the worksheet balances after each entry, as well as the grand totals. And these daily events are recorded as they happen. If we contrast that to the adjusting entries, adjustments are done at the end of the period whenever you need financial reports. The financial reports will not be accurate unless you go this extra step to do these entries. We don't get a source document coming across our desk usually like we do with daily entries. So these are more difficult. It's sort of playing detective and tracking down things to figure these out. We have accruals and deferrals. Accruals, accrual of an expense, services received. So maybe we receive the benefit of utilities, of electricity this month. Maybe the utility bill hasn't come yet. That doesn't mean we're not going to record it. So when we have an accrual of an expense, or your employees work for you at the end of the month and you haven't paid them yet, we know that retained earnings goes down because of an expense, and we have some type of liability or payable. Contrast that to accrual of revenues, where we have an opposite situation. Maybe you've got money in the bank and it's earned a little bit of interest, or not so much a savings account but a certificate of deposit. And maybe it won't mature until next year, but you can recognize a little bit of revenue this period. So there's been a benefit of some kind, and we would expect our retained earnings to go up because of revenues, and receivables and asset would also go up. On the deferral side, we defer recording revenues for things that we haven't earned. We haven't performed the services. So if you collect cash in advance, season ticket sales, deposits from customers, we cannot pick them up as revenue. So we start out with cash and unearned revenue, the liability. The adjustment is to recognize now, is any of that actually earned? And so if we have earning the unearned, basically means of that season ticket sale, what performances or sports events have actually happened. So we have retained earnings going up for any revenues that we can recognize, and a reduction to the liability, unearned revenue. The other deferral we have is deferrals of expenses. When you buy something like a car, it benefits the future, so you start out as an asset. But we all know cars eventually have to be replaced, or your computer system becomes obsolete. So many of your assets eventually break down, get used up, and so forth. So recognizing assets used up will include depreciation on property, plant, equipment, but it also includes using up things like supplies or prepaid insurance expiring. So retained earnings goes down because we have an expense, and assets go down. There are also closing entries, which we will talk a little bit about when we do the worksheet. So the horizontal worksheet, you've had a little bit of introduction to it already. Basically, it's your accounting equation, goes across the top, and then you set up subcategories. So what are your specific assets that you've used in these transactions, and different names for liabilities and so forth. As you record these transactions, make sure you recognize whether the account is going up in terms of balance or is it coming down. And that's true for your daily events as well as your adjusting. So as you record things in the retained earnings column, it's good to sort of jot down revenues, expenses, and dividends, which is a subcategory under retained earnings. In a minute, we're going to use a worksheet. We're going to actually have a separate column for each one, which fits with the lab that you have. When the transactions are recorded and you're finished with that, then you're ready to add up the columns. Make sure the left side of your equation balances with the right side. And if it does, then you're ready to go on and do your 3 statements. Looking at the statements briefly, what are some similarities and differences? The income statement and the cash flow statement are for a set period of time. It can be short, like 1 month, or it can be 12 months annually. Usually you don't have a 13-month or 14-month cash flow or income statement. We do see that there can be a lot of similarities between cash flow operating and the income statement, at least at this point, because if every transaction involves cash, then they match up pretty nicely. But that's not going to always be true. So if we look on the differences side, cash flow, as we can imagine, is only about collecting cash and paying cash. We do know for the income statement that the definition of revenue is that we earn a revenue when we do the work, perform the service, sell the product. As we know as customers, when we go into a store, many of us don't pay cash right away. So we can earn a revenue in a business and not get cash, but yet we still have to record the revenue. So that's a difference on the revenue side. On the expense side, same deal. You get the utility bill for this month. You may not drop everything, stop, and pay for it right away. You might have 2 weeks or 3 weeks to pay it, so you push that off until next month, which could be in a different accounting period. So timing is important in accounting, and we see that earning revenues, incurring expenses, not necessarily equal to the cash in and cash out. Also, investing and financing on the cash flow statement is not exactly the types of things represented on the income statement. The balance sheet is unique from the 2 other statements in that it's at one specific point in time. So December 31st, 5 o'clock, if you're on a calendar year basis, here are the assets that I own, here are the liabilities that I owe, and then the claims of the owners. We use the historical cost principle to value most assets, which just basically is whatever you paid for it stays on the books at that amount. We do expense off, we use up assets, but they're still based on the cost principle. Later we'll see the classifications. We can tweak the balance sheet a little bit. We'll have short-term assets, long-term assets, short-term liabilities, long-term liabilities, which will help us in analyzing and making sense of a company. Assets, excuse me, the ones that are fairly common, short-term assets, those that are cash or become cash quickly or used up quickly. Cash, accounts receivable, short-term investments, sometimes notes receivable. Merchandise inventory I didn't put on this list. Long-term assets would be property, plant, equipment, land and buildings, long-term investments, and so forth. On the liability side, what do we owe within 12 months? Accounts payable is usually from like a credit card or end of the period. We have a bill, we're being billed for something we bought. Notes payable, we went to the bank to get a loan, and then if we owe our employees, salaries payable, will deal with interest payable later on loans. Unearned revenue has a very different title. Again, that represents cash we collect in advance from customers that we have not performed services for or done something, whatever it is we're promising. And then later in the course, we'll deal with a long-term debt called bonds payable. Stockholders' equity at this point, the owner's claim to the business. Common stock, what the owners put into the business, which we often talk about as contributed capital. And then we have retained earnings, which we sometimes refer to as earned capital, which represents the owner's claim because the company's hopefully done well. Retained earnings goes up for revenues, retained earnings goes down for expenses, and down for dividends. So earnings being net earnings, revenue less expense. So the profits that we made in the business from day one that we kept in the business and didn't distribute out as dividends. Okay, so let's see if we can go to our problem. Here is our horizontal worksheet. We've put the transaction descriptions over here. if I can remember, we can label the cash transactions as either investing, financing, or operating, which will help us to do the cash flow. So at the top of the worksheet, if you remember, I didn't have really a good place to show it, but the accounting equation goes at the top, and it goes something like this, right? Assets are equal to liabilities plus stockholders' equity. So we put that in first, and then we'll save the space in this line for the actual detailed general ledger or ledger accounts, titles, names within the categories. And I'm going to break out retained earnings, but let's fill in the others. So you can expect to have cash. The rest of them we can wait and see which assets we actually have. And then on the liability side, I hope I left enough space here, we can wait and see what we have there as well. And stockholders' equity, you're pretty safe to assume, is common stock, what the owner again puts in the business. And then I'm going to put a retained earnings column, and I'll show you sort of like a little closing step at the end. And then the detail for retained earnings is we actually entered the transactions. I'm going to go ahead and put them not just in the retained earnings column here. We're going to not use this initially, and we're going to put our transactions into revenues, expenses, the individual columns, or dividends, which will make it a little easier to link them to the statements later. Okay, so the first event we have is we acquired cash from the issuance of stock or common stock. So the owners are giving us money. So of course cash should be going up. We have a positive number. And our common stock should be going up. And then for cash flow purposes, this is a way of raising money for the business, of financing the business, other than the day-to-day making revenues and expenses. So we'll put F for financing. Okay, and then we have, and that hopefully balances our two sides, and then we collected cash in advance for services to be done in the next 12 months. So the money's definitely there, and it sounds like customers we're working with, but the language tells us we have not done the work. So I can't use revenue over here under retained earnings. But what I can do is say that I'm promising to do the work in the future. So I'll put in unearned revenue is my promise. And that, of course, is a liability. For cash flow purposes, cash is coming from a customer. And the cash flow statement really doesn't care whether you've earned it or not. Customer cash is operating. Next, we paid rent for the month. So we paid cash. Cash is going to go down. And then if it's just for a month, then we should see over here that it goes right to expenses. We don't report more often than once a month. And again, both sides are coming down of the equation, so that both sides are affected. If we pay for more than a month, then we'll deal with prepaid, which would be an asset, which leads us right into the next one. But let me label this first. We paid for rent expense. When you pay cash for expenses, these would be operating. You can't avoid having to have rent, have a space to have your store, and so forth. So we paid for a whole year of insurance, so our cash is going out. We have an asset because it benefits more than a month. 1 month would be an expense. More than a month, we want some type of asset usually, because you don't report again more often than once a month. So this is an asset exchange. Notice it stays entirely on the left side, but it still balances because one went up, one went down. For cash flow, if we paid monthly, it would be expense, insurance expense. So just because we prepay it, still fits with that kind of idea. It's part of the operations of the business. Next, we borrowed money from the bank. So the bank gave us $2,000. We signed a note, promissory note, that we need to pay back. So that sounds like a liability. So I'll put that in the 2,000. And then for cash flow purposes, this is another way of financing the business. So we can get money from owners, which we did up at the first entry. We can also get money from creditors. We'll deal with interest a little bit later. Okay, we purchased land for cash. Small piece of land. Minus $5,000, and we're gaining another asset that benefits the future. So again, this is an asset exchange. One up, one down. Stays on the left, and the equation balances. And this one, this time, is something a little different than we've had. So this is where we see investing. Buying different types of most assets except for the prepaids. Next, we purchase supplies on account. The term on account means there's no cash. So it's either we owe the money on accounts payable or a customer owes us money on accounts receivable. Since we're buying something, it makes sense that it's going to be our accounts payable. Supplies, we assume that it's going to benefit the future. It may have more than just enough for this month. So we're going to use the asset approach. Some companies might expense supplies right away because most of it's used up. So there's supplies, and we need a liability. So how about accounts payable for $500? And no cash, so I don't have to worry about the cash flow statement. Later when we pay it, we'll deal with the cash. Then the next one is recognized service revenue on account, $2,000. Once again, we see on account. Okay, this time service revenue sounds like a customer, so a customer owes us money. So therefore, instead of accounts payable, we owing money, it's going to be accounts receivable. We plan to receive or collect cash in the future. So I'm going to pick up accounts receivable. Hard to think of any businesses now that don't have an accounts receivable or accept credit cards or something. So $2,000 under accounts receivable, the asset, and we did do the work. It's past tense, recognized. So over here I'm going to come under the revenue column and put the $2,000. Or if you'd had, your traditional horizontal worksheet, you would have typed in revenue in the margin. No cash flow yet, so again, I don't have to worry about the cash flow statement or labeling it. Next, we did pay for supplies that we purchased up here, if you remember. So we're not saying we use up supplies, we're simply paying the bill. So we owe $500, so we're going to pay off our accounts payable. So this is going to be minus, getting the right column, minus $500. And cash should go down, paying off the bills. And certainly buying supplies is part of the day-to-day running the business. It's really a prepaid account, so it will be operating. Most of the assets go into investing, but not prepaids, which include supplies, prepaid insurance, prepaid maintenance. But land and buildings go into investing, equipment, and so forth. Paid salaries at $800. So salaries is coming down, and we have a spot for the expenses. And we do the income statement in a minute. We're not going to break down all the different types of expenses. We're just going to lump them together as one for this. For cash flow, paying expenses is certainly part of your day-to-day running the business, so it's operations. Next, we collected some money from customers, collected on accounts receivable. So cash comes in, and accounts receivable goes down. Okay, for cash flow, I think you'd agree it's part of operations. It's coming from customers. Next, we recognize revenue and receive cash right away. So this is a nice situation to have when you get the money quickly. And we earned it and collected it, so I'll come over here to revenue and put that in as well. Okay, and for cash flow purposes, again, it's customers, so it's operations. Then we paid a dividend of $400. So we have to have sufficient profit, sufficient cash to do this to reward the owners. So cash leaves the business, and we actually have a dividend column under retained earnings. So it is a retained earnings account. It is possible to just put it directly and reduce retained earnings. For cash flow, it really doesn't fit very well anywhere, but accounting is an art. They decided to put it in financing, which I guess sort of fits since issuing stock is financing, rewarding the owners is also financing. Okay, we're going to go right on to the, eventually to the adjustments. We got two more. We signed a contract to perform services in February. There's been no money changing hands. We have not started any services. So this is a contract that's very important for our business, but accounting is historical and nothing has changed on your accounting equation. No change in assets, liabilities, stockholders' equity, so we don't do anything with it in your traditional accounting system. The next one is it says the land is now worth $6,000. If you remember, land was purchased at $5,000, so nice to know it went up in value, but we're not using current value accounting. So this is not needed. We're using historical cost. So we would actually ignore that in terms of the dollars and cents here. So now we're down to insurance, and we're supposed to adjust, and this, as you can see, is only 1 month, the month of January. So we purchased a policy at the beginning of the month, and the policy is supposed to start on January 1st. So it's a $2,400 policy for 12 months, and we've only had 1 month. So for this 1 month period of time, $2,400 divided by 12. Whoops, I'm looking at the wrong one, aren't I? It would help to look at the right one. It's $1,200 divided by 12 months, which we could have done in our heads, but $100 per month. So if we think about the categories of adjusting entries, this one would be an example of what? And I used to have a pop-up note, but I guess I don't. So if you remember, assets used up, accrued revenue, accrued expense, and earning the unearned. So this is an example of an asset used up. Assets used up always become expenses. So if we find the insurance, the prepaid insurance, we figured out $100. So we no longer have the benefit. We've already received the benefit for 1 month. So minus 100 on the asset side, and we would have insurance expense under retained earnings. So minus 100 under retained earnings. And when we get to these adjustments, basically there's no cash. Cash flows with the daily entries, cash in, cash out. These are looking at what's already happened or picking up entries that we don't have that don't affect cash. So accrued salaries of $1,000. Someone's worked for you, we haven't paid them yet, maybe the pay period hasn't even ended. But the accounting year period is stopped, it may be a year or something else, and we have to pick them up. We received a service. So this is an example of an accrued expense where we need to pick up the cost of those salaries. So we're going to reduce retained earnings by $1,000, and this should be hopefully under the expense column. And an accrued expense means also I need to pay for it, that I haven't paid for it yet, or would have been already on the books. So I can pick up salaries expense. There's so much in salaries that we often have a separate account for that. Or if not, you can use accounts payable. Okay, so notice it stays on the right side this time. It's a claims exchange. We can talk about the right side as creditor claims, liabilities, owner's claims. So claims exchange stays here, but the equation still balances, and that's what's important. Okay. So what's earned was what is earned that was collected in advance. So if we come back up here to the money that we actually received, this is what I was starting to do a minute ago. If we assume it's earned evenly throughout that 12-month period, $2,400 was collected for contract, $200 a month. So we'll assume that we earned $200 of that contract with the customer. So if you think of the adjusting entries, this is considered deferred revenue or earning the unearned. So we're going to look at the unearned revenue rather, which is a liability. And so of the $2,400 up here, we're going to reduce it by $200. And if you earn that, then it becomes, of course, a revenue. Okay, and then services performed that have not been billed. So maybe you've done the work and the year ended and the next day the bills are going to be sent out, but you didn't get to them. This is your attempt when you do adjusting entries to pick up everything, every revenue earned, every expense incurred. So just because you haven't prepared the bills and mailed them out doesn't mean that we shouldn't recognize this. So this would be an example of an accrued revenue where we've done something that we need to get on the books. So we can set up, well, we have actually accounts receivable. So services performed and not billed can be picked up under accounts receivable for $300. And of course it should also affect revenue. So we'll make sure we put it in the right column. Okay, there's the revenue. Okay. Then we have next that supplies were used up. Somebody counted the supplies and discovered $100 is left. So if we go up and see what we purchased originally, we purchased $500. So if we had started with 500, we only have 100 now, then 400 disappeared, hopefully because we used them up to run the business. So we have, under supplies, I'm going to go minus 400. Hopefully we can find supplies. It's right there. Minus 400. Whoops. You want the ending balance to be 100, so you want to subtract 400. And this is an example of an asset used up. So assets used up become expenses. So retained earnings goes down also by 400. So both sides come down. And then the interest, again, we'll develop this much further in later chapters, but interest is accrued on the note, and we're going to just go ahead and give you the amount. The note was up here, it was $2,000 that we borrowed, but we don't have to do the math. So this is an example of the cost of doing business. This would be an accrued expense. The note may be due in 5 years, and you're not going to have to pay the interest yet, but you need to recognize the cost of having that money this period. So an accrued expense usually sets up a payable, and I will set up, let me move my equal over a little bit. I'll set up interest payable. At this point, you don't really need to worry about the order of liabilities. Later we'll get more into that. And so interest payable will have $10. So it's that column right there. Interest payable 10. So that's going up, and then interest expense should be the middle column here, minus 10. Okay. And yeah, so the interest payable may not look like it, but it's all this is on the right side of the equation. So it's a claims exchange, one side up, one down, it still balances. Okay, now we've done all the daily entries, all the adjusting entries, which was enough, right? We're going to do some totaling up. So we can do the auto sum, which is a nice feature. And I'd like for it to go all the way at the top so I can grab the corner, hold the left mouse and pull it up. Or I could start at the top and pull it down. There's lots of ways of doing it. So hopefully that's correct for cash. 11,300. I'm just looking at something. I had a slightly different number the first time I did this, but I could have been wrong the first time. I was. I put the wrong amount for the dividends before. Okay, so this is actually okay. And then if we want, we could do each one separately, or I want this column to total up on this, so I can grab the lower right-hand part, stick it there, hold the left mouse, and pull with my this right hand, whoops, all the way across here, and hopefully get totals covering the range of each one. Let's just make sure nothing messed up. So it goes all the way to the top, all the way to the bottom above your total. Okay, it looks like it's okay. So these are the totals that we have. And we were new, so we didn't have any beginning balances. What I'm going to do next is show you the retained earnings that you set up the detail to do the income statement for revenues and expenses, but in the end I need to know what the ending balance is for retained earnings to do the balance sheet. So we did totals here. So what I'm going to do with the revenue is I'm going to take the revenue, which is $6,500. Oh, before I do that, let's do one other thing. Let's check our math. So right here I've got assets equal, equities equal. So I'm going to make sure I'm going to add up everything on the left side of the equation and see if it equals everything on the right, just to double check at this point. So I'm going to do an auto sum, and I'm going to go through the assets, which should be here. The $10 is the interest payable, so I'm going to stop there. And then equities would be everything to the right of the equals, so I'll do auto sum for that. Start with the 10, which is interest payable. Sorry you can't see the headings there. Forgot to set it up to scroll down. Yeah. Well, I didn't do that right, did I? Let me try this one more time. Auto sum. So if I pull it all the way across. Okay, so these two equal, that's what you want to make sure. Left equals the right. Then I'm going to go ahead and do this closing. So, if we do it in the order of things, we have revenue and expenses we need for the income statement. So let me just show you, if you have the revenues and the expenses, the income statement, if you remember, is pretty short at this point. Later we'll actually detail and list the individual items. So I'm just going to cell reference this over. So we have revenues, cell reference the expenses, and it shows a negative number, which I want, and then the dividends are not on the income statement. It feels like it should be, but it's not. Rewarding owners is not about the day-to-day running of your business. So I'm going to do an auto sum of those two, and there's my profit figure. So once you do the income statement, then you're really ready to kind of close this out and update your retained earnings balance. So what I can do here is, here's the revenue amount under here. So if I no longer need that figure, I can say the exact opposite. So I'm going to say equals negative and click on that. So there's minus 6,500. I'm going to bring it over to the retained earnings column. One that's got 0 is retained earnings. And I'm going to say equals and click on that again. So it's out of the revenue column over to retained earnings. Then I'm going to go down to the next line and start to deal with the temporary account expenses. And I'm going to say equals negative, do the opposite. So I'm going to add this number to the negative, and you'll see in a minute I should get 0 in that column. And I'm going to move it over to the retained earnings column. So I'm just going to do equals, and so revenue is showing as a positive under retained earnings, expenses are negative. And then last but not least, we've got dividends. So I'm going to say equals minus, do the opposite to dividends, and then bring that to the retained earnings column, equals the number. And then I'm going to do totals again, but I'm not going to worry about checking the math. So I'm going to do an auto sum over here. So what I want to do is update retained earnings. Now that I've done the income statement, I no longer really need that data. So this should be the ending balance in retained earnings. Up for revenues, down for expense, down for dividends. And then I'm going to do the same auto sum for the revenue, expense, dividend column. And it's no surprise, the temporary accounts are now 0 and are set for next period. We start all over. So we just need it to do the income statement. And then I'm just going to do a cell reference here, equals that. Nothing really has changed in the permanent accounts. Permanent accounts are assets, liabilities, stockholders' equity. They are not closed out. Any balance for one period becomes beginning for next. And hopefully my math is okay, but who knows? Okay, so from here, we're going to do the statements. I put sort of bare bones. We've done the income statement already. So how about if we do the balance sheet next? The nice thing with the balance sheet, let me see if I can do this. I'm tired of not being able to see the title. So let's see if we can hide all the stuff in between. And then we can actually see it. There we go. So these are the ending balances. And so if you remember, your balance sheet is a formal financial report. Your horizontal worksheet is an internal document that you would never use outside of your company. So we have all of our assets listed across. And at this point, I'm not going to worry about the order. Cash is usually first. And I'm just going to cell reference those guys right down to the sheet. And the nice thing there is if we make a change to the worksheet, it's going to update the balance sheet, which is all good. I'm sure there's a quicker way to do this, but we'll just do it this way. Land and supplies. So it's just the ending balances. You don't need anything else. No detail entries earlier. Okay, so if that's all of my assets, then all I need at this point is a total. I'm going to throw it to the right just to make it a little easier to see and do the math. So I'll do an auto, whoops, didn't I do that? I'll do an auto sum and add up the assets, drag that, enter, and then I'm ready to do the liabilities. So I'm just going to pick them up in the order that I find them. Interest payable is a small amount. Unearned revenue should be whatever's left after we did the adjusting entry. Oops. And then we have notes payable, borrowed from the bank, and we paid off the accounts payable. So we could list it, or we could just leave 0 there. You know, you really don't have to list it if it's 0. So I'll go ahead and go on to salaries payable. Though if you want to list it with a 0 balance, that's fine. And then we do totals. Okay, so we'll do our auto sum. Grab the ones we want, and then stockholders' equity should be common stock, which is right there as a total, and retain earnings. So this is why we wanted the totals, not just the revenue expense details. So this gives me the ending balance, and then if everything's gone right, once we get the total for stockholders' equity, then we can figure out the last number on the balance sheet. Does it kind of balance the balance sheet? So we want those two for total stockholders' equity, and then we want one final thing, which is total liabilities plus stockholders' equity. And that should be an auto sum of 2. These two. That's why, yeah, separate totals makes it nice. And so what we're checking is, do in fact the assets equal the claim side, creditor claim, owner's claim. And if you remember, we did that earlier when we did that sort of little math thing. Okay, so the balance sheet's done, and you know, as you can imagine, if I hold the control key and the tilde key, you can see all these are equations, small equations, either auto sum or cell reference. So that if we update the worksheet, everything else will update. So the income statement's pretty straightforward from the totals, balance sheet, same deal. Cash flow, a little more involved. So I've got to put some stuff back here so we can see the cash column. When you do the cash flow statement, you want to be sure you're looking at, whoops, the cash column. Uh-oh, what did I do? Made it worse, didn't I? Alright, let me see if I can find. I thought I hit unhide, but maybe I didn't. Okay, there it is. So when you do the cash flow column, you really want to be there. The adjustments you don't have to worry about because there shouldn't be any entries in the adjustment part. So we've already done the labeling. We've got 1, 2, 3, 4, 5, 6, 7 O's. It's a lot of O's. We're going to probably keep this short and sweet too. Let's do it this way. Let's deal with the customer cash inflow. And everything having to do with customers we'll put together. In fact, I'll put collected from customers. But I will be looking at the cash flow. So I'm going to say equals. And then if we go through, we had cash coming in advance from customers. So I'm going to click on that. And then I say plus. We keep going down to some of the other O's that are not, they're positive numbers. We have cash collected from accounts receivable. That's also from customers. And then we have cash just came in right away from revenues earned. Okay, so it looks like it's only 3. The other cash we have up here is from a loan, and this is from stock, from owners, so that doesn't involve. So I'm going to hit enter. And you can see cash from customers is different than revenues earned. We did not get the cash from all the customers we had, and we got cash before we earned some of the revenues as well. That's normal. That you would expect. And then what are some of the things we paid for? Let's go down memory lane up here. We paid for rent, insurance, looking at just the O's, supplies and salaries. Okay, so rent paid, insurance paid, salaries paid, and supplies is not an expense, but it's a prepaid. So it's really in operating cash in from customers and other sources that have to do with maybe interest revenue from a bank, and also cash paid for expenses and prepaids. Okay, so rent. We've got way at the top, I think, cash paid for rent. No, I didn't get up there far enough. There it is. And then we want cash paid for insurance, which is also at the top. It was prepaid, so again, it's not an expense, but it's included. And then salaries that we paid, which, as you can see, well, we'll look at in a minute, but this is different than what we're showing for salaries on the income statement. But because we don't have the detail, you don't see it. But the salaries that we accrued here for 1,000, that's not paid, so it's not included on the cash flow. And then cash paid for supplies is paid for supplies 500. So hopefully that might be it. Let's do the total and see. 2, 3, 4, 5 items. I think that's probably about right. So we can type in total, we can put in an auto sum, and grab everything under operating. And so here you do want positives and negatives. You don't usually see negative numbers, particularly on the balance sheet, because you either have an asset or you don't. It's either a zero balance or a positive balance. And same thing with liabilities. Expenses we can report as negative because we're subtracting. And here's inflows and outflows. So we have a net positive cash inflow, which is good. Then we check out the I's, which are the investing, and I think if we come back up here, we only have one. Purchase land for cash, 5,000. So because it's the only one, we can keep it short and sweet and just write land purchased, or just land even, and go right to the total. So I'm going to do a cell reference, so I'll put the equal sign, and then grab the negative 5,000 from the cell C9 or D9, I guess it looks like. Okay, and that links it there. And then financing, we did have more than one. So we had cash from owners, cash from the creditors, and cash paid to owners. So we have 3 things. So I'll put common stock issued, which was that first. Cell reference, so we link it to that cell where the 10,000 is. Then we have borrowed, let's put borrowed money, or you could put notes payable, and link that. up here. And then we have dividends paid. And that's going to be toward the bottom, I think, if I remember right. So here's the -4. Okay, so there's again inflows and outflows. I've got a total. So I need to do an auto sum for that and do 3 items. And then the net change in cash, because we started with a 0 balance, if you remember up here, we started with 0, there's nothing, and we ended with 11,300. So our cash did increase by 11,003. So we would expect this here, hopefully. Again, when you're working on homework and so forth, 10 or 15 minutes, if it doesn't balance, go on to something else. We don't want you to spend all your time. Fortunately, mine came out to 11,300, so I don't have to pull my hair out or look for my solution to see where I went wrong. But spend a small amount of time and then go on. So there's your horizontal worksheet completely filled out. Again, we didn't use retained earnings column until we got to the end. We put everything in the sort of a more spread out version. And then we moved the revenue over, the expense and the dividend over to the retained earnings column, struck an ending balance. And if we had beginning balances, they would have been above here. We would have added that to everything that we have or subtracted. So that's the horizontal worksheet and the 3 statements.